Good morning, Jax. This is Fahad. Today is Tuesday, January 5th. Let's get started. Georgia runoff elections today, so that's going to have some impact in the markets depending on whether Democrats or Republicans maintain the control of the Senate. We will know the results tomorrow, so that's going to be the main headline everywhere for the next 24 to 48 hours. But I'm not going to say any more than just that. Just a reminder, it's a big one, so we'll find out. Now, with that said, let's take a look at specific stocks. Mercado Libre, many years ago, it was way back in 2015, I bought a starter position in Mercado Libre at $125 per share. This was when I was still with Option Monster. And at the time, I recommended all my clients to buy the position as well. Since then, I have never sold this position. It's been 6 years I've been holding on to it. All the volatility in the meantime, up and down cycles and everything, but always maintaining a very high conviction bias on this name as a pure play on e-commerce, on fintech, on cloud, on all sorts of things as the biggest player in Latin America. And here we are. This stock now trades at 1640. The position is up about almost 1300% since then, since the purchase point. Remains one of my biggest positions in the portfolio. And even here at $1,600 per share, I'm reiterating the bull case after Bank of America note came out this morning. Now, understand that the market internals have been rolling over in this market in the past couple of days, so we're going to get pullbacks in the next couple of weeks. There's a chance that this market will continue to correct overall out until Biden takes the office on January 20th. So for the next 2 to 3 weeks, possibly up until January expiration, option expiration that is, we're going to see momentum basically gradually continue to crack. Now, with that said, these pullbacks that's going to happen in some of the best growth companies out there are going to present buying opportunities ahead of their next earnings report. And I think you're going to get those opportunities over the course of next 2 to 3 weeks, setting up for a nice comeback after they post blowout quarters because they have significantly benefited from COVID-led disruptions. Mercado Libre is one of them. So you want to keep an eye on this one. This stock closed at 1640 yesterday. It will probably come down from 1640 and retest this trend support. This trend support is all the way down around 1470 currently. So it depends how quickly it gets there. That would equate to a total correction, price correction of about 10 to 15% in stock after reaching a high of 1735. Once it dips below $1,500 per share, I believe that's when you pull the trigger with a hard stop on the stock to buy call options, and I'll be all over it once that moment comes, and we will be recommending trade idea in the chat room or official trade idea by email. Now, with that said, Bank of America has a very interesting bullish note out this morning. They are raising the price target to street high. Now, this is just a one-page note. There's not a lot of tidbits about exactly what they expect from the upcoming fourth quarter results. So this is a high level note, but they're going from $1,550 to $2,100 on a rolling basis. So basically this is based off of now 2022 estimates with the earnings growth rate that is continuing to stay strong versus 2021 previously. They always like to keep their price targets out based on 1 year out earnings estimates. Bank of America, in the qualitative note, they say that while buyers and sellers, receivers and payers continue to drive network effects, Mercado Libre is accelerating dynamics by further addressing frictions, relevance, and values. Improved and resized infrastructure, speeding delivery and accommodating demand. First-party offers are addressing high-velocity categories and gaps, and several efforts are sharpening price points. Brazil Pix and interoperability are also accelerating QR adoption while facilitating digital wallet use. Simultaneously, Mercado Libre is adding a consumer credit card in Brazil and a growing area of investments, including lending and insurance products. We also expect the launch of US dollar savings product in several markets over the coming 12 to 24 months, which we expect to be one of the wallet's most powerful long-term catalysts. On this last point about company expecting to launch a US dollar savings product in the several markets in sometime in 2021 and 2022, which will become the biggest, most powerful driver of growth for wallet. Think of it the same way as PayPal in the United States in many ways, and other fintechs. And that's what I mean, that this company continues to build out the platform in Latin American nascent market where there is little competition, and Mercado Libre is the absolute top leader, and this will continue. Is staying on the fintech path. It's not just Mercado Libre that benefits from all these strong trends. Another name which is connected with MELI is PagSeguro. This is another name that we very, very much like, and this will likely also pull back slightly. It also pulled back yesterday a little bit already. I think this may get down to 51 or $52 per share. I don't see this thing coming in further than that, and that too will present a buying opportunity. It's worth noting that there is a note out on this one too, and this one speaks to actual channel checks for the fourth quarter, which should translate into a very, very strong earnings. This comment also came out from Bank of America today about PagBank, which works closely with Mercado Libre's e-commerce division. The digital banks in Latin America and e-wallets saw downloads in December expanded by 102% year over year, which was a sharp acceleration from 21% year over year growth in the number of download apps in November, and it reached an 18.9 million downloads in a single month. Of all of those, PagBank, as you can see, was one of the best performing ones, up 2.1 million downloads, or 295% year over year, while all the others also benefited tremendously. There is some competition, but PagBank, given its close relationship with Mercado Libre, still remains one of the best to benefit from these trends. So watch these stocks, just keeping a high level over here, because this market, as it sells off over the next 2 weeks, it's going to present some really good opportunities to get long names ahead of their next earnings report. And I believe these two should be on your watch list to take advantage of that when that moment comes. That's it from me. Jay.
Morning, everyone. So 2 items to quickly talk about. First one, a quick update on REITs AI, ticker RNLX. This morning.
This name, by the way.
Yeah,
I love this name because I saw yesterday too the relative strength technically on this stock, and then I went back. A lot of the times I go back and reread our own research. So your notes on this one in the past 2 months, I did that yesterday again and refresh my thoughts again. But go ahead.
Yeah, so just today or this morning, the company announced a partnership with DaVita, so ticker DVA. Just reading the press release, or actually the Stifel note to be more specific. The Kidney Intel X assay will be used to stratify patients into risk groups, at which point those with mid and high risk scores will receive care via DaVita's integrated kidney care program. Importantly, the expected outcome of the collaboration will also be used by RNLX to pursue expanded indicated use claims for Kidney Intel X. The partnership is expected to launch in 3 markets this year and intends to pursue risk-sharing agreements with payers and healthcare providers. The Kidney Intel X rollout remains early, but partnerships such as this one offer additional opportunities to help drive data, adoption, and awareness. Now, I'm not seeing much action pre-market, but we'll see what happens once people realize the news is out.
That actually could be a significant one because DaVita is one of the biggest operators of kidney dialysis centers in the United States. It is the biggest, if I'm not mistaken. Nobody even comes close to that. And REITs is only what, $400 million company, something like that, 4 or 5 of them, very, very small. This partnership could become quite substantial going forward from here. So an interesting one. We'll be watching this one closely because if this thing moves, this can move 15, 20, even 50% out of nowhere very, very quickly. And this chart has been acting very strong on rising volume in the past couple of sessions. We reiterated the bull case in webinar 2 weeks ago. So a lot of JEC clients are already long. Since about, I believe, $11 or $12 per share, right around here is when we reiterated the bull case in webinar. So this thing is already up 40% position-wise, but this is still, in my opinion, the beginning phase of the far more upside to come. Good upside.
And then the second stock to keep an eye on is Stanley Black & Decker, ticker SWK. Now, last month, the company did come out with a press release talking about their 2020 planning assumptions. And they updated some of the numbers. They said organic growth for Q4 was approaching 10% versus the prior assumption of 3 to 5%. Free cash flow is assumed to be greater than $1 billion versus the prior assumption of 800 to 900 million. But then yesterday, B of A actually downgraded the stock to underperform from neutral. And my takeaways from the note really revolve around the rising competition at Home Depot, at Lowe's, and how those are still not yet well understood. But before talking about the competitors, another item that B of A points out is that their retail analyst team is forecasting a pretty sharp slowdown in same-store sales growth at both Home Depot and Lowe's. Now, for pretty much all retailers, you're going to get, as you progress through the year, you're going to get tougher comps due to COVID. But more specifically, Home Depot, B of A is saying they're going to go from positive 18% same-store sales in 2020 to just 1.7% in 2021. Meanwhile, Lowe's, which is a far more important driver for Stanley, they're expected to go from 24.6% growth in 2020 to negative 3.3% in 2021.
Wow.
So yeah, that definitely caught my eye.
Yeah, just quickly on that one, this is something that's why it's going to be very difficult and very interesting in the first 6 months of 2021, to navigate in some of these earnings cycles, because some stocks tremendously benefited from COVID and some stocks got destroyed from COVID in the first half of 2020. So on a year-over-year comparisons for some things, we're going to look at optical growth that's going to be out of bounds, like maybe hotels and casinos and such, and restaurants. But for some others, like the one Lowe's and Home Depot, Lowe's is going to minus 3% same-store sales growth year over year. That's optically is going to be a disaster, for the investors. So that's what something definitely to watch.
So just going back to the competitive landscape that I talked about, Stanley has a $1.4 billion business at Home Depot, but there's another company called Tectonic Industries, which offers the Ryobi and Milwaukee brands. They're essentially extending their leadership there with aggressive investment in lithium ion technology for the outdoor power equipment space. So, one competitor right there. And then, as I said, Lowe's is far more important for Stanley. Because I think 2.2 billion was the number that B of A gave, from which Stanley generates at Lowe's through their Craftsman and DeWalt brands. So one of the things that B of A points out is to address the rise in competition, they were considering buying out the remaining 80% of a company called MTD Products, which is a gas-fueled outdoor power equipment company. But while it's mulling this opportunity, another company called Chevron is bringing its Ego brand into Lowe's after leaving Home Depot, where it's been there since 2014. Lowe's has already started selling this Ego product. I believe it was last fall, and it's supposed to be in all the stores by February of 2021. And B of A basically says, we don't think this development should be taken lightly, as Chevron left Home Depot after a long relationship as a major cordless outdoor supplier, and Lowe's will become the exclusive nationwide retailer to sell the Ego brand.
Interesting. Technically, there's a very easy entry over here because the stock is pulling back. $162, $163 is major VOP support. Stock closed at 169 yesterday. Let's see how the market will react today. But the type of raises that you're talking about in terms of revenues and the EBITDA and the free cash flow numbers going up to $1 billion free cash flow there. This is all very, very positive while the stock is gradually continuing to correct. So let's see if this thing settles in right around at this VOP level and forms a little bit of a base. And that setup will be interesting because the RSI is now down to 36 with the earnings coming out on January 28th. We may have a setup here for a potential reversal after the earnings comes out and a return back to new 52-week high. I'm going to add this to my watch list today. This is a very interesting update, and see if we can make a play on this one into earnings. Good stuff. Chronicle.
Morning. A couple items this morning, one bullish, one bearish. First off, my favorite chemicals play, Celanese, caught an upgrade to outperform this morning from BMO with a price target of 155, which I believe is the street high. And in addition to our bull case of reduced downtime from recovering demand, their analyst, John McNulty, states that within the acetals business, low inventories and outages have resulted in sustained spikes in China, price spikes in China, which should result in higher earnings through 2021. Additionally, he also added that approximately half of the company's acetic acid produced now goes downstream, and the contribution of chain and emulsions and powders is now 25%. And this ability to move downstream has allowed the company to adjust its product slate to drive higher profitability going into next year, this year, sorry. But on top of what the analyst is saying, I would also add that the company itself is currently implementing a variety of cost reduction projects, which will result in roughly $200 million of savings. So we should expect a free cash flow and margin boost from that too. And it's only going to get better with pent-up demand from within Asia Pacific. And so I continue to believe that any dips in this stock are buying opportunities. I think around 120 would be a nice spot to add. So that's my first item.
Yeah, I'm just going to quickly add to this that it feels to me that every once a week maybe, or once every 2 weeks, I hear the Dow Jones Newswire reports that Celanese is raising prices here, Celanese is raising prices there. So the average selling price, they do a very good job in keeping investors fully informed of the real-time changes in their average selling prices for their end products in various markets, whether it's regionally raising prices or just raising prices on various products. Anytime when I hear those news, they all start to stack up, one after another, weeks and weeks and weeks of this. And this is all boost for margins, US prices. And one last thing I would also to say about this real quick is that for those who bought the Jaguar first quarter outlook, and if you go down and if you look at the macro section of it, you will see that but the biggest risk that I highlighted in the macro section is a potential spike in inflation rates, which is an out of consensus view, not fully baked in, because for everybody right now simply looks at the slacking economy without fully taking into account that inflation could be spiking sharply. But that's exactly what I expect could happen by the month of May. When that happens, the US PPI will start to push higher. When PPI goes up, there's an 87% correlation between the end prices of chemical companies and the PPI, producer price index that is, and that's how these chemical companies start to see significant amount of margin boost. So I guess what I'm trying to get at is when this company reports earnings, which is going to be in a couple weeks, Celanese that is, I expect them to talk about this very thing that Chronicle just mentioned about the US margins going higher, which supports higher free cash flow and all of that. From a macro top-down approach as well as the bottom-up approach, the NIM continues to be very, very attractive, and technically as it pulls back, $118 to $120 per share should be very, very supportive for stock. Good stuff. And you had one more, right?
Yep. Second thing this morning is just wanted to point out that it's very telling that during yesterday's sell-off, the sectors that are traditionally defensive, like utilities and REITs, they sold off heavily yesterday, which is basically a continuation of what we saw last year as well, where, even when we had the COVID-19 sell-off, these so-called defensives didn't respond, and many of them actually capitulated and massively underperformed. So what's going on here? I think it comes down to three things. First off, the utilities and REIT sectors have been littered with bad assets and bad balance sheets going into the pandemic, which puts a ceiling on cash generation. Now, part of this is because of high capex over the years, but a lot of it is to do with financial engineering, especially with the utility companies, where many of them have dividends and buybacks that exceed free cash flow. Like, in essence, a lot of them are borrowing money to pay dividends and do buybacks. So these stocks have become value traps, and even more so with lending standards tightening due to the pandemic. Secondly, we're currently in a rising rate environment with a steepening yield curve. And if we were to overlay the charts of utilities and REIT stocks with the 10-year yield, for instance, we'll find that there is somewhat an inverse correlation, because if we think about this logically, whenever the risk-free interest rate rises for the economy, that's when the dividend yield of defensive stocks become less attractive from a risk-taking perspective, because what's the point of getting 3 or 4% dividend yield if we can start to earn 1 to 2% risk-free? Like, when it comes to opportunity costs, it starts becoming more attractive to put money into riskier assets to get a better relative return. So this is the gist of why they tend to underperform in a steepening yield curve and rising risk-free rate environment, for which the 10-year yield is a good proxy. And then the third reason is because the pandemic is still very much rampant. So whenever we get global news of escalations, like yesterday, that leads to a reflexive sell-off for all sorts of non-industrial REITs, and also the highly levered utility companies. So I guess the main message here is that, at least for the current cycle, we can't find protection in utilities and REITs. Those high dividends are not worth the underperformance, and I think we're better off sticking with precious metals as a safe haven for the moment, which is what we were recommending in yesterday's Jaguar Live. And in terms of specific REITs we're bearish on, we continue to dislike Boston Properties, symbol BXP, and Essex Properties, symbol ESS. If you recall, we discussed those companies several times last year in Jaguar Media and also the Q4 quarterly outlook. I think they're decent hedges in this environment, but again, we want to be tactical here. So look for opportunities to short them at resistance levels and then take profits before they reach support, and rinse and repeat until the fundamental picture changes, which won't be anytime soon. So those are the two things on my mind this morning: remaining bullish on Celanese and continue to dislike most REITs.
Yeah, just a reminder to everybody that Boston Properties BXP, which is starting to roll over after this post-election bump or rally that we saw, there's a gap that remains to be filled down to 76. The stock is at 90. Yesterday was a pretty big bearish engulfing candle, but it does have all this VOP support levels. Nevertheless, this could be gradually heading back all the way down to retest or fill this gap all the way down to 76. And this is the bear case, a peer trade idea, long MAA short BXP, that was presented a while back on July 8th in Jaguar Media. There's also a big research note that's attached over here, so along with the slide deck. So for those who like to read up on this one, you can take a look at all of this to fully understand exactly why this is a bearish call from us. And then similarly on ESS, this was a Jaguar top short recommendation in the fourth quarter outlook, which initially was doing quite well up until the election time. So you can see throughout in the month of October, in the fourth quarter, this stock was continuously falling and making nearly new 52-week low. And then election happened, and then suddenly everything basically surged as the money moved from growth to value, resulting a sharp increase. But since then, it has been rolling over. Big bearish engulfing candle in this one yesterday as well. And let's see if this thing is going to take out all of this VOP supports around 214 to 220. And if so, this could be making its way all the way back down to new 52-week low as well. So again, this one, ESS, was a top short in the fourth quarter outlook. Great stuff, Chronicle. Thanks for updating on these. All right, folks, that's it from us. We'll see you in the chat room shortly.